Good morning, everyone. Welcome to this update for the global markets for the 30th of August. And it was just an extraordinary week. It really was. So we'll have a look at the details of that. First of all, apologies for my voice. I don't feel all that flash, but the voice sounds worse than it is. So hopefully I'll get through the next 10 or 15 minutes or so because, look, it really was a really important week. It's scared a lot of people around the world, and I guess the question for most people now is where to from here? What can we expect over the next few weeks or the next few months? So let's jump into it and have a look, and I'll just start with the big picture first. And look, as I said last week, this is a correction that was well overdue. It was a correction we had to have just to restore the market to a bit of a healthy state. There's been a lot of alarmists and people, calling for crashes and all sorts of things. They always come out of the woodwork when these sort of events happen. But the fundamental precursors for a major top in the market and an extended bear market are just not in sight, not even remotely. So for me, that is just not a consideration. Yes, China's not doing all that well. Europe's not doing all that well. Japan has been not been doing well for a couple of decades now. But as far as a sort of a catastrophe that some people are pointing to, there's just no way it's going to happen. There's almost no chance of a recession in the US, and monetary normalization, which, in other words, getting back to normal levels of interest rates other than the really low rates we've got now, is never the end for stocks. And I've covered this over the last couple of weeks. I think it was about 2 or 3 weeks ago, where I had a look at what happens when interest rates start to rise, what happens to the stock market, and in fact, generally you can look for between 1 and 2 years of pretty positive stock markets once interest rates start to rise. But I do expect that volatility will continue for some weeks yet. So whilst we've had just an amazing amount of volatility in the last 5 days, I think we're going to continue to see more of that. Now, it doesn't mean that we form lower lows. We may have already seen the low. I'm not sure, but it's certainly. I don't think we're going to see any kind of extended bear market. So the correction of the last week was mostly about China, people's fears about China. It was irrational to a degree. But I just want to point out a couple of salient facts. The S&P 500 index companies generate about 67% of their sales in America and only 10% from Asia. So it just doesn't have a massive impact. And China accounts for less than 1% of US exports. So even if China is going into some sort of protracted slowdown, and I don't necessarily agree that that's the case, then it's the impact on American stocks, which is, as you know by now, is pretty much my focus. Then it's not really going to have that much impact on the American economy or on American companies. So the correction that we've had in the last week and a bit is about uncertainty. It's not about any factual evidence that things are changing. With regard to China, there are some negatives. Certainly, PMI manufacturing numbers are down, and the growth rate is slowing. But the media is just not reporting some of the positives. China's in transition from an infrastructure building, export-led economy to one that's more about internal consumption, more about services. And there are some real positives around that transition, but the positives just aren't being reported. So everyone's jumping on the very biased report, the negatives about China, and that's just what's happened. Now, amazingly, after a 1,000-point fall in the Dow on Monday night, temporarily, that happened in the space of about an hour, the S&P ended up rising 18 points on the week, which is just extraordinary. And I haven't seen volatility like this even during the GFC. So for those people who forget that a period of minimal volatility, which is what we've had for a lot of this year, and we'll look at that on the chart in a minute, always leads to a volatility breakout. Now, we don't know which way that breakout will be, whether it's to the upside or the downside, but the breakout is always generally very substantial. And people that forget about that low volatility gets preceded by high volatility, are destined to pay a pretty heavy price for that. So last week I indicated that there was a support target at 1940. We absolutely blew straight through that, and that the next target was 1822. That was touched almost to the number in the futures market, not in the physical market. So that happened about an hour before the physical market opened. But at that stage, the American market was massively oversold, and hence we got this amazing rebound that we got. But from here, the way the market rebounds during this rally phase tells us a lot about how things are going to unfold. So for me, there has been a caution flag waved, but I've been waving that caution flag for 2 or 3 months anyway, so that shouldn't have been a surprise to anybody. But I believe the volatility we've seen in the last week will be reversed, but it is going to take a bit of time. And September is not a particularly strong month either. And this mini crash that we've had was really a lot about computer programs, computer algorithms driving the selling. So this was not so much about human beings making decisions that were rational or irrational. This was more a case of the computers took over. So let's take a look at the S&P 500 index, and we'll look first of all at the big picture monthly chart, and you can see that finally we've had a disruption to the uptrend that we haven't seen for some time. We did have a little bit of a spike down in October of last year, and we've still got a day of trading to go, so the US market could finish back up above this blue moving average line, which is the 12-month moving average line. So that still could occur yet. We'll have to wait and see, but it's been disruptive, and we're likely to get a bit more yet. If you come over here to 2011, which was the last time we got a decent market correction, you'll notice that the market had come off the boil just a little bit, but then August had a big dip and a partial recovery, so very much like this time. And then September was down, and then that was the low point, and then it turned around again. Now, because there is no fundamental economic change of trend in the economy, I'm expecting this pattern to look something similar. So I'm expecting that September could be weaker, could finish below the October, a bit below the August close. Whether it finishes below the August low or not is another question. You notice over here in 2011, it didn't. It closed lower than August, but didn't go below the August lows. So I think there's every chance that we'll see the same sort of pattern this time round. Looking at the daily, you can see this was Friday. That was Thursday. Then Friday, big sell-off. Monday, big sell-off. Tuesday, sell-off, and then the massive rebound. Now you'll notice I've put a Fibonacci scale on this decline, and how far back up this goes will tell us a lot about the strength of the market. Now already we've gone straight through the 38.2% level. We're getting very close to the 50% level. If we're able to get up above 2000 and get up towards this 2029 level, then that would be a real positive for the market, and I would feel much more comfortable about September. But we'll just have to wait and see. Turning to Aussie stocks, the Aussie dollar remains in downtrend, but it did bounce off a major inclined support line. So for those of you that have got funds in America, it's a real positive. I think the fall in the Australian dollar, how we go from here, I'm not sure in the very short term, but I think longer term the drivers are still in place to drive the Australian dollar lower. Now, the ASX 200 index also amazingly ended up rising by 50 points on the week. And we did see the commodity majors, BHP, Rio, and probably also Woodside joining in. And this often happens during a correction, so that wasn't a particularly unusual occurrence. So let's just look at the Aussie index. So there we go, heavy sell-off. So we're well and truly back into the channel. We had a false break to the upside. We've probably got what is now a false break to the downside, but you've still got a downtrending channel in Australia. So you've got to be even more careful in Australia than you do overseas. This is the Aussie dollar. This is a long-term chart going back. This is a monthly chart, so it goes back quite a period. So you can see there's a strong trend line. We hit that during the week. We had a little bit of a bounce, but nothing of any substance yet. So we'll keep an eye on that. Now, commodities, gold declined by $27 for the week, despite an initial blip up on Monday and Tuesday when the market fell over. So just when the gold bulls were getting excited, gold price started to fall again towards the end of the week. And as I've been saying for a long time now, if you want to know where the price of gold is going, then you want to look at the gold stocks first, because they're going to lead in both directions. And I made note last week of the fact that the gold stocks hadn't really looked that encouraging. And we saw the gold stocks turn back down again, and we also saw gold turn back down again. So we're still not at a time when you should be looking at gold stocks. Copper was up slightly to $2.33, finding a bit of support at that level. Crude oil was all over the place. It was down under $40 and then reversed sharply back up and finished at 46. So for the week, it was probably unchanged, but traded over a huge range. The last time we saw a one-day 10% gain, which is what we saw on Friday, that was made in December 2009, and that was the start of a very substantial run up in the price of oil. But I think these circumstances are completely different, because in 2009, the price of commodities absolutely collapsed due to the GFC. So that was more of an economic fundamental situation, and it wasn't really related to supply and demand. The current decline we've got is very much about supply and demand, and I don't see that has changed at all. So for me, this is probably going to be a dead cat bounce in the price of oil, and I think it's going to be down under $50 for some time. There's the spot copper chart. So you can see we've just starting to form a little bit of stabilization in spot copper, but it's fallen quite a long way. So overall, we're looking at August and September, traditionally weakest time of the year. Anyone who wasn't well positioned for that just wasn't listening and wasn't observing, because it's been a long time in the coming. But we just need to see how September starts. If you are cashed up and well positioned, then you can aim to start buying, but I would be buying the biggest spikes down. I wouldn't be looking to buy just any little old spike. I think you need a bigger edge on your side this time. Don't be impatient to buy. This is a time for being, fairly disciplined about what you do. I wouldn't buy too much too quickly, even though the prices might look attractive. I'd only just buy progressively over time. And I just want to make the final point that building financial security is a serious goal for anybody, and it requires discipline. And I talk to a lot of people that seem to take a fairly cavalier attitude about how they're building their wealth. This is really a terrific time. The opportunities are eye-wateringly good, but getting back into the market does require some discipline. So, very important to do that. Now, I'll wrap it up there because my voice is just about gone, and hopefully it'll be back in normal shape next week. So apologies for the sound quality. For anyone that wants to talk to me or understand more about what we do, how I might be able to assist you, then there's my email address and the website. It's been good. I've actually been contacted by quite a lot of people in the last couple of weeks. So I suppose this market conditions has convinced a few people that maybe they need some more input. So it's been good talking with those people, and hopefully can talk to some more. That's it for this week. Cheers.